Welcome to the deep dive. We take the sources, pull out the key details, and give you the real story.
That's right.
Today, we're diving into a real estate heavyweight. The Phoenix Mills Limited, they've just announced, well, a pretty huge strategic move.
The really significant one, yeah.
And it could completely reshape their future.
Wow.
Plus, we'll cover their latest quarterly results. Our goal here is to cut through all those dense reports, the earnings calls, and give you the essential insights.
The surprising bits, the aha moments.
Exactly. About this big strategic play and their recent performance.
And to do that, we've gone through, well, pretty much everything. Their Q1 FY26 results, the investor decks, the full earnings call transcript.
So we're connecting the dots for you.
Yeah, linking it all together so you understand not just what's happening, but, why it actually matters.
Okay, let's jump right in then. The biggest news, I think, it wasn't just the financials this quarter, right? It was this major strategic development. Phoenix Mills is buying the remaining 49% stake in Island Star Mall Developers, Private Limited ISMDPL.
That's the one, from CPP Investments, the Canada Pension Plan Investment Board.
Right.
And what's really interesting here is just the scale of it and what it implies.
Right.
Once this deal is done, Phoenix Mills owns 100% of ISMDPL. So they get sole control over this, frankly, high-performing retail and office platform.
A platform they've been building for a decade.
Exactly. They've really nurtured it. It's like taking full ownership of, well, your start creation.
And you can see why they'd want that full control when you look at the platform's track record. I mean, ISMDPL started back in 2017 with just 1 million square feet of retail.
Yeah, seems small now.
Right. Fast forward to today, it's around 6.6 million square feet. Operational retail and office assets in key cities, Bengaluru, Pune, Indore.
Good growth centers.
It's not just growth, it feels almost explosive. And it generated what, our 617 crore in EBITDA in FY25?
Correct. That's the 6.6-fold increase in just 8 years.
6.6 times, that's huge.
It really is. And the why behind grabbing the whole thing is pretty clear.
Okay, tell us.
Management sees significant untapped growth still left in ISMDPL.
So there's more juice to squeeze?
That's the idea. Full ownership means they capture all the upside. From new construction coming up, from development potential they haven't even used yet.
So it stops the, quote, leakages they mentioned to minority interests.
Precisely. They think this could potentially grow Phoenix Mills' attributable EBITDA 3, maybe 4 times over the long run.
Which directly feeds into net profit growth.
Exactly. Big impact potential.
Okay, now the financing, this is where it gets interesting, right? How are they paying for this? It's a big number, ours, one in 5,449 crore.
It is a big number, but they're being quite smart about it. They're staggering the payments to CPP Investments over 36 months.
So 3 years in 4 chunks.
4 tranches, yeah. And here's the clever part for their own books. They're funding a substantial amount of it from ISMDPL's own surplus cash and internal accruals.
So the asset helps pay for itself.
Largely, yes, plus some incremental debt, but specifically at the ISMDPL level, not burdening the parent company directly.
Okay.
Management really hammered this point home. ISMDPL is a strong cash-generating machine, and the deal is, quote, significantly accretive from the first year itself.
Accretive meaning it boosts earnings per share.
Correct. Boosts it right away. They gave an example. Even if that first payment was entirely funded by debt at ISMDPL.
Hypothetically.
Yeah, purely hypothetical. Phoenix Mills' share of the operating free cash flows from ISMDPL could still jump by 58%, just based on last year's numbers.
Wow. Okay. That is significant accretion.
And they built in flexibility, too. Payments can be made through buybacks, dividends, capital reduction, secondary transactions.
Lots of options.
Which means basically their overall balance sheet stays strong. Phoenix Mills keeps its liquidity for other growth plans.
Which raises the question, though, why would CPP Investments exit now? They've been partners for a decade.
Good question. The official line from management was mutual discussion, not an obligation for either side to buy or sell.
Mutual discussion.
Yeah. You could read into that. Perhaps CPP sees their best returns already made, or maybe they're just reallocating capital globally. But for Phoenix Mills,
they see upside.
They think the timing is perfect. They're banking on a huge valuation upside, especially from those ISMDPL office spaces.
Which are currently pretty empty, right? Only 6% leased.
Very low, yeah. But they're targeting 90% occupancy by 2026. That ramp up is where a lot of the value unlock is expected.
Right. So think about this, you listening. Whether you run a huge company or a small business, getting full control of something successful,
It changes the game.
it really can accelerate growth, simplifies everything. It's about unlocking that full potential, knowing you're completely in charge.
Makes sense.
Okay, so that's the big strategic shift. But how did the company's overall engine perform in Q1 FY26? Let's look at the consolidated picture.
Sure. So consolidated level core operations look pretty healthy. Total revenue from operations hit Rs, 953 crore.
And how does that compare?
That's a solid 5% increase compared to Q1 last year.
Okay, decent growth. What about profitability, EBITDA?
Consolidated EBITDA earnings before interest, taxes, depreciation, and amortization was up 6% year over year. Came in at Rs 564 crore.
So profitability growing slightly faster than revenue, that's usually a good sign.
It is. Shows good underlying performance. Net profit after tax, though, was a bit flatter. Up 2% to Rs 320 crore.
Okay, and earnings per share.
Diluted EPS landed at Rs 6.73. So overall, a stable foundation, you could say.
And what about debt? With this big acquisition pending, are they loading up on debt?
Well, the group's gross debt stood at Rs 4,435 crore. Net debt after cash was Rs 2,657 crore.
How does that stack up, the debt to EBITDA ratio?
Their net debt to EBITDA ratio was around 1.2x, which is actually quite manageable for a company like this, especially in real estate.
Okay, not overly leveraged then.
No. And what's also quite positive is their average cost of debt actually went down slightly to 7.92% in June 2025.
Interesting. So they're managing their financing costs well.
Seems like it. Shows financial discipline, a healthy balance sheet overall.
Were there any sort of, one-offs or unusual items in these Q1 numbers we should know about?
Yes. Just one thing to note on the depreciation line.
Okay.
Depreciation for the quarter included an accelerated depreciation charge of about Rs 7.38 crore.
Why accelerated?
It wasn't normal wear and tear. It came from changing the estimated useful life of some investment property, partly because they're actually demolishing some existing retail blocks at Phoenix Palladium for redevelopment.
So they're writing off the old faster to make way for the new.
Exactly. Clearing the decks for higher value developments. It's a non-cash charge related to that future growth.
Got it. Okay, now let's peel back the layers. How did the individual business segments perform? Starting with retail, what stands out there, especially with all this strategic talk?
Right, retail. Consumption, basically. What people spend in their malls was strong. Rs 3,588 crore. That's up a healthy 12% year over year.
12% consumption growth, okay.
And collections.
Gross retail collections also up by 7% to Rs 853 crore. But, and this is where it gets interesting.
Retail rental income only grew 4% to Rs 506 crore. And retail EBITDA was also up just 4% to Rs 535 crore.
So consumption is growing much faster than their actual rental income and profit from retail. What's causing that gap?
Yeah, that's the key question. Management was very direct about this. They said it's temporary and strategic.
The strategic how?
They're doing a major repositioning exercise at several key Phoenix Market City malls, Mumbai, Pune, Chennai, Bangalore.
Repositioning, like shuffling tenants.
Exactly. They're actively churning brands, resizing stores, relocating others, basically replacing lower performing formats with, higher performing new age brands.
So they're taking a short-term hit on occupancy or rent to get better tenants long-term.
That's precisely the play. Think of it like renovating a prime property. It causes disruption now, maybe lower immediate returns.
But the goal is a higher value asset later.
Exactly. So while their leased occupancy stayed high, over 95%,
Right.
their trading occupancy that's actually open and generating sales dipped temporarily to 89% in June because of this churn.
Makes sense. Stores are closed for renovation or fitting out?
Right, but they expect it to bounce back to the usual 95% plus stabilized level.
Do they have examples of this working?
They do. At Phoenix Market City, Bangalore, they mentioned resizing an anchor tenant, the projection, double the monthly rental, and a 5x increase in trading density from that space.
Wow. Okay. That's a significant uplift.
And at Phoenix Mall of Asia, they deliberately held on to about 8% vacancy, right on the prime upper ground level.
Why hold vacancy?
For luxury and star brands. They just closed some deals with new watch brands at really high minimum guarantee rentals around Rs 550 per square foot per month.
So being patient paid off with premium rents.
Seems so. They're also adding new things, like the Gourmet Village, 12 food outlets launched in July at Phoenix Palladium West Zone, and Game Palacio for entertainment.
Diversifying the offering and the spending mix. Still fashion heavy.
Still dominated by fashion and accessories, yeah. That's 55%. Then jewelry at 13%, electronics 10%, and F&B also 10%.
Okay. What about the commercial office side? You mentioned that's key to the ISM-DPL upside. How did that segment do?
Commercial offices saw Q1 income at RE's 52 crore, up 4%.
Mm-hmm.
EBITDA was RE's 74 crore, up a healthier 8%.
And occupancy overall?
Across the currently operational assets, it was 70%.
Still room to grow there. Any leasing activity?
Quite a bit, actually.
Mm-hmm.
About 4.07 lakh square feet leased in Q1 across Mumbai, Pune, Bengaluru, and Chennai.
That's decent momentum.
Yeah, and pre-leasing has started at one national park offices in Chennai, which is nearing completion. But the really big story is the strategic vision.
Which is?
Filling up those newer towers, they're aiming for 90% leasing by 2026 for Phoenix Asia Towers and Millennium Towers.
Which are currently at very low occupancy, right? Like 11% and 3%.
Exactly, so there's massive potential upside there. They're projecting significant EBITDA growth just from that ramp-up.
Are they confident they can fill them?
They seem to be. They pointed to their Chennai office asset, which hit 60% leasing in just 4 months. So they feel they have the formula.
Okay. That's promising. Now, hospitality, often a good bellwether for consumer sentiment. How did hotels perform?
Hospitality had a really strong quarter, suggests robust demand, especially at the premium end. Q1 income was RS 130 crore, up 11%.
And EBITDA?
Even better, up 19% to RS 58 crore. Margins expanding there.
Nice. Any specific highlights?
The St. Regis in Mumbai. It performed very strongly. Occupancy at 83%.
That's a high.
Very. And RevPAR, revenue per available room, jumped 11% to over R's 15,000.
Wow.
ARR average room rate was also up 13% over R's 18,500. So they're getting more people in and charging them more.
Strong pricing power. What drove the revenue there? Rooms? Food?
It was pretty balanced, actually. F&B contributed 46%, rooms 44%.
Interesting. And the other hotel, Agra?
The Courtyard by Marriott in Agra also did well. 71% occupancy, RevPAR up 19%, ARR up 5%. So good performance across the board in hospitality.
Good to hear. Finally, the residential segment. How were home sales?
Residential showed really strong sales traction. Q1 gross sales hit R's 168 crore.
How does that compare to last year?
It's a massive jump from just R's 50 crore in Q1 FY25. So demand seems to be booming.
And collections. Did the cash come in?
Collections also rose significantly.
Yeah.
R's 99 crore, up from R's 60 crore last year.
What kind of prices are they getting?
Average sales price was around R's 27,000 per square foot.
Premium segment.
Definitely. But there's a timing aspect here with revenue recognition.
Ah, okay. Explain that.
So while sales were very strong, only R's 40 crore actually hit the revenue line in Q1.
Why the difference?
Revenue is typically recognized upon registration of the property. So the rest of that R's 168 crore in sales will flow through to revenue in the coming quarters as the paperwork completes.
Got it. So it's a timing difference, but the sales are booked. A future boost to reported revenue is already baked in.
Exactly. It's a positive indicator for future quarters.
Okay, so pulling all these pieces together, the acquisition, the segment performance, and what does the path ahead look like? They talk about this ambitious super campus vision.
They did. It's
Yeah.
a really grand plan for Phoenix Market City, Bangalore.
What does it involve?
It's a multi-phase expansion aiming for over 4 million square feet in total. The goal is a world-class, integrated, mixed-use destination.
So more than just a mall.
Much more. Phase 2 is already underway. It includes that gourmet village we mentioned, 19 restaurants, launching 2026. A Grand Hyatt Hotel, about 400 rooms, finishing in 2027.
Right.
And Art Exchange offices, about 0.4 million square feet, also completing 2027. They specifically mentioned the hotel is designed for high performance, using lessons learned from the St. Regis Mumbai.
Smart. And phase 3?
Phase 3 aims for completion around 2030. That adds a second hotel, around 300 keys, more offices, another 1.2 million square feet, and more retail, about 0.6 million square feet.
Wow. That's huge. What's the underlying idea?
To create this self-sustaining ecosystem, where the offices feed the retail and hotels, the retail draws people to the offices and hotels, everything works together.
Boosting footfall, dwell time, spending.
Precisely. A virtuous cycle across the entire campus.
Wait, that's a massive specific project. Beyond that, where else is growth coming from? What other levers do they have?
Well, one interesting point is their Balanced Floor Space Index, or FSI, potential.
FSI, that's like the leftover building rights on land they already own.
Exactly. They still have about 2.7 million square feet of this FSI potential combined across existing developments in Indore, Pune, and Bengaluru.
So they can build more on land they already have.
Yes. It offers future densification, future value creation, without needing immediate big spending on new land. That's quite efficient.
Okay. Anything else?
Infrastructure improvements nearby. Phoenix Citadel in Indoor, for example, is expected to get a big boost from new roads, a flyover, an underpass nearby.
Improving access.
Right. Should complete by 2026, significantly improving access and hopefully footfalls. And then there's the overall vision for FY30.
What are the big targets?
They're aiming for a portfolio of 14 million square feet of retail, 3.5 million of offices, 1,200 hotel keys, and another 2.5 million square feet of residential.
That's significant scale across the board.
It is. And they also highlighted their sustainability efforts, ESG.
Important these days.
Very. 3 of their newest malls got LEED Gold ratings. They're doing solar power, smart building tech, water conservation, EV charging, ticking those boxes too.
So putting it all together then, the ISM DPL deal, the operational improvements, these big growth plans, they seem pretty confident.
They project significant free cash flow generation going forward, and they feel they have ample borrowing capacity or leverage potential to fund these growth plans.
What's the planned spending for the near term, CapEx?
For the next 12 months, the estimate is around 1,200 to 1,300 crore in capital expenditure at the group level.
Okay, manageable within their projections.
Seems to be the plan.
So if we connect this all back to the bigger picture, what does this deep dive really tell us?
I think it really highlights how combining strategic consolidation like the ISM DPL buyout with that constant operational optimization, the retail churn,
Right.
and having a very clear long-term development pipeline. That's a powerful formula. It positions a company like Phoenix Mills for sustained, potentially compounding growth, even in a market that's always changing. It's about building ecosystems, not just buildings.
That's a great way to put it. So as you listen to this, what stands out to you? Beyond the numbers, beyond the big plans.
Yeah.
Think about how a company can evolve its core assets, like they're doing with the Market City malls, how they integrate different offerings, retail, office, hotel, how they leverage existing land and infrastructure.
Creating that compounding value.
Exactly. What could that kind of integrated thinking mean for other industries or companies you follow? Where else could creating an ecosystem unlock that kind of hidden potential? Something to think about.
Definitely something to ponder.
Thank you for joining us for this deep dive into the Phoenix Mills Limited.